tax asset and different scenarios where valuation needs to occur and where it doesn't. And then we also look at how to handle it under IFRS. So it has a deferred tax asset with a couple different scenarios. Zeta Corporation reported taxable income for 2019 of $200,000. The enacted tax rate for 2019 is 40%. During 2019, Zeta became the defendant in a lawsuit. The lawsuit has not been resolved at the end of the period, but Zeta's lawyers believe that it's probable that the company will be held liable. The legal office estimated that the amount of loss will be $80,000. As a result, the lawsuit has been recognized as a contingent liability. However, the legal obligation is not deductible for tax purposes for 2019. The lawsuit represents the only difference between financial income and taxable income for the year. Assume that Zeta Corporation has been quite profitable in the past periods and expects to continue that pattern for the future. Record a journal entry to recognize tax expense, tax payable, and deferred tax for 2019. And so in this situation, they're telling us that they've been profitable in the past periods and expect to continue it. In other words, saying we don't need to do a valuation of that deferred tax asset. And so for our journal entry, we're going to have income, tax expense, and we're going to have income tax payable. And let's fill those two out first and then see if this middle one is going to be our deferred tax asset or deferred tax liability. And maybe it's already obvious to you just based on the words here, but we're going to start with these two accounts. So our our income tax payable is going to be equal to the $200,000 times our 40% for $80,000. And now we have, before we get to income tax expense, we have this missing account of either a deferred tax asset or a deferred tax liability. And in the situation, they're saying we estimate that we're going to have a loss of $80,000, which would obviously reduce our income. And so that's a deferred tax asset. And so we'll put our deferred tax asset here, and that's going to be equal to our $80,000 times the 40% for $32,000, and the tax payable minus our asset will give us income tax expense of $48,000. And like I said, because of this, we expect that pattern of profitability to continue. There's no valuation that needs to occur. Part 2 says, assume that there is substantial doubt about whether Zeta Corporation will be profitable in the future periods. As a result, the company believes that 1/2 of the future deduction of legal costs will not be realized. Record a journal entry to recognize the tax expense, tax payable, and deferred tax for the year. And so in this situation, part 2, our initial journal entry would stay the same. And then we would also need below that to have the allowance to reduce the deferred tax. So we'd have income tax expense, allowance to reduce deferred tax asset to realizable value. And that's going to be equal to our deferred tax asset times 1/2. Okay, and then the next part, prepare your answer to requirement 2, assuming that Zeta prepares financial statements according to IFRS. And so under IFRS, a valuation allowance is not recognized. Instead, the deferred tax asset is recognized at the amount for which it is probable that the company will have sufficient future taxable income against which to utilize the deferred tax asset. And so we'll have our income tax expense, deferred tax asset, and our income tax payable. So I'm just going to copy those down. And now it just looks slightly different because our tax payable stays the same, but our deferred tax asset is just going to initially be recorded as the 80,000 minus 1/2, so minus the 40,000 times our 40% tax rate. And so you can see that the ending impact is the same because income tax expense under scenario 2 still ends up being that same 64,000. However, we're just breaking it down into these two different transactions using the allowance to reduce the deferred tax asset to realizable value, which doesn't happen in the IFRS scenario.